just less rigid. So there is more scope to be able to focus on delivering the aims, the long-term aims for the stakeholders, and doing that affordably within and managing contribution levels in an appropriate way.
So even though, I mean, they've had a more benign discount rate environment, I mean, arguably you could say closed is sort of caught up to those sort of levels-ish now. Kensington Chelsea is not alone in using that discount rate, so they must have, to have this incredibly positive funding position, have done something differently from an investment perspective to be in that position today. Can we talk a bit about what have they done differently to other either pools or other individual partner funds of the LGPS?
Yeah, I think the one thing, if you just step back a minute for the whole of the LGPS has a relatively high weight to growth assets, and specifically listed equities. So whenever anybody looks at the LGPS from the outside looking in, they go, "Wow, there's quite a lot of equity risk in there." And Kensington Chelsea's at the upper end of that. If you look at this data that's disclosed, it's in the 80% plus type numbers, depending on how you think about private equity, but it's 80-85% in equity. So it's got a high equity weighting relative to the broad LGPS, which has a reasonable, there's a high weighting to equity risk anyway, compared to other, you might say, other pension schemes. So by virtue of having had a high exposure to equities looking backwards, the portfolio's performed well. And the impact on the forward-looking is the discount rate. I have to say, I had a quick look. I don't know what the discount rate they're using is, but it's going to be at the higher end of things, because you have a high equity weighting, which means the actuary is almost certainly going to say your forward-looking portfolio has got a higher expected return than if you owned a load of gilts, for example. So there's the combination of those two, and that then has then given the scheme the scope to manage contribution rates for employers. However, what we found quite interesting is when there's various scatter charts you can look at, and there's one that's produced by PERC, and we've done the same internal analysis that shows you expected volatility versus backward-looking return. I think it's the last 5 years. And if you look at that, you see a big blob of the bulk of the LGPS funds in a zone, and then 4 funds stand out as different outside that blob. One of them is Kensington Chelsea, with higher levels of return and higher levels of expected volatility and risk. And there's 3 others that stand out with a more moderate level of return, or a slightly lower level of return, I should say, it's only slightly lower, but with noticeably different risk levels